Hey everyone, welcome back to Corporate Decoder. Today we're diving into MultiSensor AI Holdings' latest annual report. It's like peeking under the hood of a car, but instead of an engine, we're looking at their finances. And trust me, there might be a few unexpected turns, or maybe not. Let's see. This report is for the year 2024, ending December. We'll check if MultiSensor AI is cruising or maybe needs a bit of a jump start. MultiSensor AI Holdings, who are they exactly? They build and deploy those smart multi-sensing platforms using things like thermal imagers, acoustic imagers, and other cool sensors. It's all about measuring heat, sound, vibration, and gases in industrial stuff. Think of it as giving companies super sensors to protect their equipment. This is their official ID with the Securities and Exchange Commission, kind of like a social security number for companies. The company has submitted all their interactive data files electronically, which is a good sign. It means they are being open with their information. The value of all the company's publicly available stock in June 2024 was about $5.6 million. This tells us how investors valued the company back then. Now, let's see the juicy details. A core part of their business is using high-resolution thermal images, which let them see heat. They're also using visible and acoustic images to sense sound and vibration, plus sensors for gases. Thermal imaging, the one that detects heat, it was first used in military applications for night vision, and even in astronomy now it's used to find failing equipment to spot hotspots. They are enhancing thermal image sensing with acoustic and visible image sensing, as well as vibration monitoring. That means they can see, hear, and feel what's going on with equipment. If they can use all these sensors at once, they should be able to predict when machines will fail. Their devices use a large range of spectrums encompassing visible light, shortwave, midwave, and longwave infrared images, ultraviolet images, and even laser spectroscopy. So they have many sensors. They also come in many sizes, from handheld to systems on drones. MSAI Edge is their on-site software, like having a mini computer right there to process data. It's like having a smart assistant on the factory floor. It watches equipment, sends alerts, and integrates with existing systems. MSAI Connect is their cloud-based software. It uses AI. It predicts when equipment will fail, which saves companies money and downtime. This software can take a huge amount of data, like big data from sensors, and analyze it all in real time to catch problems early. One of their big strengths is that proprietary SaaS technology. It means they have their own exclusive software. To stay competitive, they need to keep innovating and releasing new products, meaning they are keeping up with the latest technology. They mostly sell directly, but also through dealers. So more partners mean they can reach more customers. They think their total addressable market is over $10 billion, and they're targeting warehouses, factories, and oil and gas companies. There are limited third-party sources. That means they rely on certain companies, and if those companies screw up, MSAI has problems. They depend a lot on a few big customers. If they lose those customers, it could hurt their finances. Some of their customer, supplier, or partner contracts could be terminated. That $10 billion market they're hoping for, it's just an estimate and it might not be accurate. To stay on their growth trajectory, they may need to issue stocks. The stockholders may experience a dilution. Cyber attacks are a real threat. If their systems get hacked, it could disrupt their business. Okay, let's look at some numbers. The balance sheet is like a snapshot of what the company owns and owes. Their cash position increased to $4.3 million, a big jump from $1.1 million last year. That's a good sign. They have more cash on hand. Let's talk about what's happening with the stock. Their net loss was about $21.5 million, similar to last year's $22.3 million. That means they're still losing money, but it's not getting much worse. Here's a key point. Revenue is around $7.4 million, which is up from $5 million, better than less. They spent $3 million on stock-based compensation this year, a huge drop from $14.1 last year. They spent $15.6 million in operating activities. That means they are spending more cash to just keep the business running. Hopefully that changes. They need to make sure they have good internal controls. Otherwise, they may produce inaccurate financial statements. The company needs to keep their listing on the stock market, or things could get rough for investors. Changes to trade policy, tariffs, and import tax regulations may have a material adverse effect. So what's the takeaway? MultiSensor AI is in a potentially lucrative space, but faces challenges. They're still losing money, but revenue is growing. They need to manage expenses and avoid pitfalls. Their reliance on a few big customers could backfire if those customers leave. Their success hinges on getting their software as a service business running smoothly. And here is the biggest red flag of them all: substantial doubt about its ability to continue as a going concern. So guys, now let's zoom out and give a quick take on MultiSensor AI. The good, the company has innovative multi-sensing tech with high potential, and it is in a high growth area, so they have that going for them. Revenue is growing. They have an innovative solution for critical assets across industries. The concerning, they are still losing tons of money. They rely on a few key customers and have substantial doubt about their ability to continue as a going concern. Overall, MultiSensor AI is a high-risk, high-reward situation. The tech is promising, but they need to execute flawlessly. Fine, thanks for watching. Don't forget to like, comment, and subscribe for more corporate deep dives.